Friends, thank you for being here today. We stand at a precipice of financial history, looking out over a landscape that has fundamentally changed overnight. What if I told you that the artificial ceiling placed on real money, a suppression scheme that has lasted for decades, has not just cracked, but completely shattered? And what if the very mechanisms designed to control this market, the so-called kill switches of the banking elite, were pulled yesterday only to find they had been disconnected by the sheer force of physical demand? On December 23, 2025, the world witnessed an event that financial historians will likely recount for generations. Silver, the restless metal, the poor man's gold, the industrial workhorse of the modern age, did the unthinkable. It didn't just touch the psychological barrier of $70, it smashed through it with the momentum of a freight train, reaching an intraday all-time high of $71.11 per ounce in U.S. markets. This is not merely a number on a screen. It is a declaration. It is the definitive signal that the era of paper price manipulation is crumbling under the weight of undeniable physical scarcity. To truly grasp the magnitude of this moment, we must first look back at the history it has overwritten. To understand the gravity of $71.11, we must appreciate the context of the last half-century. For 45 years, the ghost of 1980 haunted the silver market. In that year, the Hunt brothers' famous attempt to corner the market drove nominal prices to $50. Adjusted for inflation, that peak would be over $150 today, yet the nominal number stood as an iron ceiling. Then came 2011, where silver made a valiant run, reaching $48.70, only to be crushed by margin hikes and regulatory intervention. For over a decade since, silver languished, often ridiculed as a dead rock, trading in the frustrating range of $20 to $30 while gold marched to new highs. Critics said silver would never break out. They said the banks had infinite paper supply to cap any rally. They said the industrial demand didn't matter because the derivatives market was the tail wagging the dog. Yesterday, December 23, 2025, proved them all wrong. The trading session began with a palpable tension. Bids were pushing $70.64, already a precarious level for the short sellers. Then, in a flurry of buying that swept through the New York session, the price vaulted. It didn't stop at $70. It stamped a high of $71.11. The significance of this specific price point cannot be overstated. It represents the total failure of the kill switch. In previous rallies, when price velocity became dangerous for the bullion banks holding short positions, we would see sudden, inexplicable sell walls. Massive dumpings of paper contracts designed to trigger stop losses and scare retail investors. We saw margin requirements hiked overnight to force liquidations. They tried those tactics this week. Margin requirements were hiked from 9.5% to 15% in mid-December to manage volatility. Rumors of spoofing, placing fake sell orders to create the illusion of supply, were rampant. Yet the price rose. $71.11 happened anyway. This failure of suppression indicates a structural break in the market. Physical demand has finally and decisively overwhelmed paper trading mechanisms. The emperor has no clothes, and the market has just noticed. Now let's dissect the anatomy of this rally and analyze the numbers, because they paint a picture of a market in a true parabolic phase. This was not a flash crash or a fat finger error. It was the culmination of a relentless ascent. The year-to-date performance of silver leading up to this moment has been nothing short of spectacular. Starting 2025 under $30 per ounce, silver has rallied approximately 137% to 140%. To put that in perspective, technicians look for parabolic curves, patterns where the slope of the price increase gets steeper and steeper. That is exactly what we are seeing. The time it took for silver to move from $50 to $60 was measured in weeks. The move from $60 to $70, that took mere days. This acceleration, or the shortening of intervals between 10 milestones, is the classic signature of a repricing event. The market is realizing it is mispriced and is rushing to correct itself before supply completely evaporates. On the day of the breakout, the price action was instructive. We opened strong around $68.96. As geopolitical news hit the wires during European hours, the climb began. By the time New York liquidity came online, the rocket fuel was lit. We saw a surge to $71.11, followed by a retraction to close around $70.96. Skeptics will point to the pullback and say, see, it failed. But any veteran trader knows that a close near the highs, especially on a day with thin holiday volume, is incredibly bullish. The pullback to $69 to $70 was classic profit-taking. Traders who had ridden the wave from $50 were locking in life-changing gains. The fact that the market absorbed that selling pressure and still held the 70 handle is testament to the strength of the bid beneath the market. This raises the critical question, why is this happening specifically right now? Markets are rarely moved by a single factor. They are moved by a confluence of events that create a perfect storm. In this case, we had a trifecta: geopolitical escalation, monetary pivots, and the exhaustion of physical inventory. Let's start with the geopolitical spark. The immediate trigger was undoubtedly the situation in Venezuela. The United States escalated sanctions dramatically, moving from threats to actual enforcement actions against Venezuelan tankers. Ships were detained, insurance was pulled, and payment systems were frozen. This economic warfare was compounded by a confirmed cyber attack on PDVSA, Venezuela's state oil company, which took critical systems offline. Why does Venezuelan oil matter for silver? Because energy is the lifeblood of the global economy. When you disrupt energy flows, you spike inflation risks. When energy security becomes a question mark, capital flees from paper assets, which rely on stability, and runs toward hard assets. Silver, being both a monetary metal and an energy metal, critical for solar and nuclear, is a prime beneficiary of energy chaos. The market immediately priced in higher manufacturing costs and supply chain delays, driving a safe haven bid that spilled over from gold into silver. But the context is broader than just Venezuela. We are living in a world of fragmented geopolitical relations. Tensions in the Taiwan Strait, the unresolved conflict in Ukraine, and the continuing powder keg in the Middle East have created a baseline of anxiety. Furthermore, the BRICS nations are accelerating their de-dollarization efforts. We are seeing trade settled in yuan, rupees, and crucially, gold. As the world moves away from a single reserve currency, the value of neutral, tangible reserve assets like silver rises. Adding fuel to this fire was the Federal Reserve pivot. Governor Christopher Waller, historically a hawkish member, dropped a bombshell of commentary signaling that there is room for monetary easing in 2026. The markets, which act as a forward-looking pricing mechanism, immediately digested this. Traders priced in 2 rate cuts for the upcoming year. This is the Fed pivot that gold bugs have been waiting for. Lower interest rates reduce the opportunity cost of holding non-yielding assets. If you can get 5% in a savings account, gold and silver are less attractive. But if rates are falling and inflation is rising due to the aforementioned energy shocks, the real yield on cash turns negative. In that environment, silver becomes the ultimate asset. The dollar softened on this news. Not a collapse, but enough of a dip to provide a tailwind for commodities priced in USD. While these catalysts provided the spark, the structural deficit has been the true engine driving this rally. The driver of silver's move to $71.11 is the undeniable structural supply deficit. We are now in the 5th consecutive year where global silver consumption has exceeded global silver supply. Think about that for a moment. For half a decade, we have been eating into our above-ground stockpiles. The estimates for the 2025 deficit range from a conservative 118 million ounces to a staggering 149 million ounces. This leads us to the problem of the production cliff. Why can't we just mine more? This is the most common question from those who don't understand the geology of silver. Silver is unique because it is primarily a byproduct. Approximately 70% of the world's silver comes from mines that are digging for lead, zinc, copper, or gold. If the price of silver doubles, a copper miner isn't going to double their production just to get a little more silver. Their economics are driven by copper. Furthermore, primary silver mines are rare and depleting. The world's largest producers, Mexico and Peru, are facing severe headwinds. In Mexico, regulatory uncertainty and resource nationalism have chilled investment. In Peru, labor strikes and community protests frequently halt operations. Global mine supply has been stuck in a band of 800 to 850 million ounces for years. Even if we found a massive new deposit tomorrow, it takes 10 to 15 years to bring a mine from discovery to production. The permitting process, the environmental studies, the infrastructure build-out, it is a decade-long slog. There is no cavalry coming to save the supply side in 2026 or 2027. The supply curve is flat and arguably declining. On the other side of the equation, we are dealing with an inelastic beast, industrial demand. Demand is exploding, and it is a type of demand that price cannot easily destroy. In 1980, silver demand was largely speculative and photographic. Photography demand died with the digital camera. Today, silver is the indispensable metal of the green energy transition and the digital age. Driving this is the solar revolution. Photovoltaic, PV demand is the juggernaut. Estimates for 2025 put solar demand at 260 to 300 million ounces. This is driven by a massive rollout of solar capacity in China, India, and the West. But it's not just the number of panels, it's the technology inside them. The industry is shifting toward TOPCon and HJT cells. These high-efficiency cells require 30% to 50% more silver paste than previous generations. While engineers are trying to thrift or reduce the amount of silver used, the total growth in installations is vastly outpacing their ability to thrift. Beyond solar, we have the surging demand from EVs and AI. An EV uses significantly more silver than an internal combustion engine car. up to 50 grams per vehicle for contacts, managing battery loads, and electronics. With millions of EVs hitting the road, the demand is baked in. But the new wildcard that caught analysts off guard is the artificial intelligence boom. AI data centers are power-hungry beasts that generate immense heat. They require high-density power connectors and thermal management systems. Silver is the most conductive metal on Earth, both thermally and electrically. It is non-negotiable for high-performance computing. Projections see this sector's demand rising tenfold by 2030. This demand is inelastic. If you are Samsung or Tesla and silver goes from $30 to $70, you don't stop making phones or cars. The silver is a tiny fraction of the total cost of the device, but it is essential for its function. You pay the price. You have to. The inevitable result of this imbalance is that the global vaults are draining. Where has the silver come from to fill this deficit over the last 5 years? It has come from the vaults. It has come from the eligible stockpiles in COMEX and the warehouses of the London Bullion Market Association, LBMA. But those stockpiles are finite, and they are flashing red warning signs. In the futures market, there are two categories of silver inventory: registered and eligible. Registered silver is metal that has a warrant attached to it. It is ready to be delivered to settle a contract. Eligible silver is metal that sits in the vault but is privately owned and not necessarily for sale. Leading up to the $71.11 breakout, we saw a disturbing trend. Eligible inventories were draining rapidly. In the 2 weeks prior to the ATH, over 3 million ounces were withdrawn from eligible status. This means the owners of that metal, likely sovereign wealth funds, family offices, or shrewd high net worth individuals, decided they no longer wanted their metal within the exchange system. They wanted it out. They wanted it in their own possession. This phenomenon is known as taking it off the table. It indicates a deep distrust in the solvency of the exchange. If you believe the price is going to the moon and you fear the exchange might change the rules or default, force settle in cash, you take your physical metal and you run. Simultaneously, we are seeing inventories at the Shanghai Gold Exchange, SGE, hit multi-year lows. China is vacuuming up silver for its industrial machine. This creates a potential arbitrage situation. If silver is scarce in Shanghai, the price there rises relative to New York, sucking even more metal from the west to the east. The global vaults are being drained from both ends. We must also consider the institutional pivot and ask, has the giant woken up? For decades, the name JP Morgan was synonymous with silver price suppression. The commercial shorts were the villains of every silver bug's narrative, but the data suggests a plot twist worthy of a Hollywood thriller. Recent reports and market analysis suggest that JP Morgan, the behemoth of the banking world, has flipped. They are no longer the naked short seller trying to hold back the tide. Instead, it appears they have spent the last decade using the suppressed prices to accumulate the largest hoard of physical silver in history. Estimates range from 500 million to 750 million ounces. If this is true, the game theory of the silver market has changed fundamentally. The biggest player is now incentivized for the price to rise, not fall. They have positioned themselves to be the primary beneficiary of the squeeze. This explains why the kill switch failed. You cannot suppress a market when the biggest whale in the ocean decides it's time to swim up. The banking cartel is fractured. Some are still short and are likely suffering catastrophic losses right now, but others have pivoted. This lack of unity among the suppressors allowed $71.11 to happen. I want to hear from you on this critical point. Do you trust that the banks have actually flipped, or do you think this is just another trap before a massive rug pull? Let me know your thoughts in the comments below. So, what does the road ahead look like for 2026 and beyond? Is $71.11 the peak? Most analysts believe it is merely the end of the beginning. We are entering 2026 with a tailwind that is rare in financial markets. Analyst forecasts are aggressively revising upward. Peter Schiff, a longtime precious metals advocate, is calling for $100 silver in 2026, driven by a restart of quantitative easing, QE, to bail out the sovereign debt crisis. Clem Chambers points to the AI energy supercycle as a driver for 100 plus. Even conservative institutional models like those from WisdomTree and BNP Paribas are targeting $75 to $100 by mid-year. The scenarios generally fall into three buckets. The bull case is the short squeeze scenario. If we break the $75 resistance cleanly in Q1 2026, the momentum could trigger a cascading failure of short positions. The shorts scramble to cover, and industrials panic buy to secure inventory for their factories. Price discovery becomes vertical. In this scenario, $120 to $150 is not out of the question. The base case sees consolidation. The market needs to digest the move from $30 to $71. We might see trading in the $65 to $80 range for a few months, establishing a new floor before the structural deficit grinds the price higher toward $100 late in the year. The bear case involves a severe global recession hitting, crushing industrial demand by 10 to 15%. However, because of the supply constraints, even a drop in demand might not crash the price back to 30. The floor has likely moved up to $60.65. We must also confront the most explosive variable of all, the awakening of the retail public and the return of silver as money. As we look toward the horizon of 2026, there is one final crucial piece of this puzzle that we cannot ignore: the human element. Specifically, the sleeping giant of retail investment and the psychological phenomenon of a monetary reset. If you walk down Main Street today and ask 10 people about the price of silver, 9 of them will not know it has just hit an all-time high. This silence is deafening, and it is incredibly bullish. In 1980, the mania was visible. There were lines around the block at coin shops, and people were melting down their family silverware to cash in on the craze. Today, despite the price-shattering records, we are seeing no such euphoria. The rally has been driven by smart money, sovereigns, and desperate industrial buying. The average retail investor, the crowd that drives the final, most vertical phase of a bubble, has barely arrived. We are currently in the disbelief phase of the market cycle, where the public assumes the price is too high and will crash. But what happens when disbelief turns into realization? We are about to witness the Giffen good effect in real time. In economics, a Giffen good is a rare anomaly where demand actually increases as the price rises. Precious metals often behave this way during monetary crises. At $25, silver was boring. It was dead money. But at $71, and soon perhaps at $100, it becomes a validation of a worldview. It becomes unobtainium. As the price climbs, it signals to the public that their fiat currency is failing, triggering a feedback loop of panic buying. When the mainstream media, CNBC, Bloomberg, and the nightly news, begin to cover silver not as a commodity story but as a death of the dollar story, the floodgates will open. Consider the gold to silver ratio, GSR. For most of history, this ratio hovered between 15:1 and 30:1. Even with silver at $71, the ratio remains historically stretched if gold continues its own ascent. A reversion to the mean, a return to historical averages, implies that silver has to run significantly faster and harder than gold. If gold hits $3,000 or $4,000, which is entirely plausible in a sovereign debt crisis, a 30.1 ratio would put silver well over $100, potentially targeting $130 or higher. This mathematical gravity exerts a constant upward pull on the white metal. Furthermore, we must understand the psychology of the unobtainium phase. We are approaching a point where the paper price on the COMEX may completely detach from the physical price on the street. We are already seeing premiums of $10 over spot for eagles and maples. In a true squeeze, you might see a screen price of $80, but a street price of $120, if you can find any metal at all. This backwardation, where the spot price is higher than the futures price, screams of shortage. It incentivizes traders to drain the vaults immediately, reinforcing the very scarcity that drives the price up. This is not just a trade, it is a monetary revolt. The global debt levels are mathematically unpayable in real terms. The only way out for governments is to inflate the debt away, to debase the currency. Christopher Waller's comments on easing are just the admission of this reality. In this environment, silver reclaims its historic role not just as an industrial input, but as money. It is the only financial asset that is not simultaneously someone else's liability. When the public realizes that their bank deposits are losing purchasing power by the month, the rush into tangible assets will be unlike anything we have seen in our lifetimes. The silence we hear now is not the absence of interest. It is the calm before the stampede. If you are finding value in this deep dive and want to stay ahead of the curve as this historic wealth transfer unfolds, please make sure to smash that like button and subscribe to the channel. It helps us wake up more people to this reality. Ultimately, friends, this signifies the beginning of a great wealth transfer. What we are witnessing is a repricing of reality. For too long, the financial world has operated on the delusion that paper claims on wealth are the same as wealth itself. The rally to $71.11 is the market waking up from that dream. This event represents a massive transfer of wealth. It is a transfer from those who hold paper, fiat currency, bonds, unallocated contracts, to those who hold physical reality. It is a transfer from the weak hands who sold during the long, boring years of consolidation to the strong hands who understood the fundamental math of supply and demand. The strategy for this new environment is clear, though not without risk. Volatility will be extreme. We will see 10% to 15% corrections that will shake out the timid. But for those who understand the structural deficit, these dips are gifts. The priority now is physical possession. In a market where exchange inventories are dwindling and rule changes are a constant threat, if you don't hold it, you don't own it. The squeeze everyone has whispered about for years is no longer a theory. It is here. It is happening in real time. The kill switch has failed. The physical market has asserted its dominance, and while $71.11 is a historic number, the fundamentals suggest it is just a mile marker on a much longer journey. Thank you.